Okay, let's take a look at closing entries. All right. Now the closing entries, what we're going to focus on is getting these revenues and expense accounts closed out plus the dividends, and we're going to move all that up to the retained earnings account so that when we're looking at this equation here for the retained earnings statement, our ending retained earnings balance is going to end up being this $26.75. Okay? Now, in the book, let me just tell you that they do use an income summary account, and I will tell you flat out, I am more of a practical accountant, and we do not use those in the accounting systems. PhDs that write books like to use those accounts, but practical, you'll rarely ever see an income summary account. So we're going to go ahead and I'm going to make a recommendation. So if we go over here to this post-closing trial balance tab, this is the journal entries that I'm going to recommend for practical purposes. Although remember, in your Cengage, all of those accounts or journal entries they're going to ask you for are going to be based on the journal entries that you will see on page 144. Okay, but I just wanted you to see it in this format because I think it's a little more direct. It's a little takes out a second step of an income summary account, and you can see a little bit better what we're actually doing. So notice what's happening here. We're actually closing out the revenue account. Remember, revenues go up with credits, so if we need to zero that balance out to get started for the new year, then we've got to debit the revenue accounts. Then expenses, remember, they go up with debits, so if we need to zero those out, we need to credit all those expense accounts. Now, if you close revenues and expenses at the same time, the amount that is going to be moved into retained earnings as a credit to increase retained earnings should look familiar to you, and that number is the income, the net income number that you can see on the income statement from page 142. Okay, then if you close out the dividend accounts, that's going to reduce retained earnings. So essentially what you're doing here is you're moving that net income and subtracting out the dividends and moving all of that to the retained earnings account. So let's do that in detail. All right, we're going to post these two journal entries. Okay, so let's go over here to the closing journal entries tab, and let's close out these items. So again, right now, revenues are sitting out there with $16,900. All right. So to zero that out, we need a $16,900 debit. Okay. So now the balance is zero. Okay. All right. The expense account has a $28.80 in the debit side, so we need a $28.80 in the credit side. Same thing for all of our other expense accounts. So we've got a utilities expense of $5,200, so let's credit that utilities expense. Let's credit the depreciation expense. Let's credit the interest expense. And let's credit the insurance expense. Okay? Now, we got one more, two more. All right? Actually, let's close the expense first. All right, so here's the supplies expense. All right, so we've closed out the revenues and the expenses. Now, again, remember, going back over here, remember we needed a credit to retained earnings of $31.75. So if we come over here and we post a credit $31.75 to the retained earnings balance, look what happens. The balance sheet comes right back into balance. But now we've got a net increase in retained earnings of $31.75, and now revenues expenses are now all zero, so now we're ready for the new year. Okay? The other thing that we need to do is we need to close out the dividends. So right now, dividends has a $500 balance in it. Dividends go up with debits, so we need a credit for the dividend account. We now zero that out. We come up here to retained earnings. We reduce retained earnings by $500, and now we have retained earnings balance of $26.75. All right. So remember, go back to that the flow of those financial statements. We calculated the $31.75 net income. Net income increases retained earnings. Then we subtract the $500 in retained earnings. So now you're sort of looking at that retained earnings statement there. So you can see we started the period with retained earnings of 0 because it was the first year that we were in business. We earned net income. We paid out dividends. So now our balance in retained earnings is $26.75. So then next year, when we start calculating our statement of retained earnings, we'll start off with a beginning retained earnings of $26.75. We'll post more revenues, more expenses, more dividends, and then we'll accumulate those throughout the year. Okay? Then at the end of the year, we'll close out revenues, expenses, and dividends. We'll roll that up to retained earnings, and we'll get a new ending retained earnings balance for that year that we will carry forward to the next year. Okay? And we'll do that again and again and again. Now, understand one thing about closing entries. Closing entries only occur once a year. Okay? In Chapter 2, we did daily entries. Those happen on a daily basis. In Chapter 3, we did adjusting entries. Those happen on a monthly basis. So those will happen at the end of each month because we got to make sure that revenues and expenses are recorded in the month in which they're incurred. Okay? Then closing entries will happen at the end of the year. Okay? So in Chapters 2 and 3, it sort of looks like we're going to close out entries at the end of the month, but that is not actually the case. We'll only do closing entries once a year. So once those entries are posted, okay, scroll back through. Uh-oh. Hang on one second. Let me find. I've got an error somewhere. Okay, sorry about that. In all my cutting and pasting for this spreadsheet, I forgot to add the retained earnings account in there. Alright, so you can see now that we've got everything closed out, dividends are now 0, revenues are 0, and expenses are now 0. Again, the retained earnings balance is now sitting at $26.75, and debits equal credits, so all of our debits for our closing journal entries were posted as debits, and all of our credits in the closing journal entries were posted as credits. So you can see this is the process that we go through. It's a timeline if you want to think of it that way. We do daily journal entries, posting into the general ledger. Then we do an unadjusted trial balance. Then we do adjusting entries, post those into the trial balance, post those into the general ledger, and then we get an adjusted trial balance. We'll do this process every month. So this will be our daily journal, the balances after our daily journal entries. Then we'll post our adjusting journal entries. Then we'll get adjusted trial balances. We'll do that every month for 11 months. Then on the 12th month, at the end of our year, then we will close all of the revenues, expenses, and dividends, post those entries into the general ledger, and then we will get a post-closing trial balance. So again, now we'll start the new year with zeros for all of our temporary accounts. Okay? So think through the timeline. Daily journal entries, unadjusted, posting into the general ledger, unadjusted trial balance. Adjusting entries, posting into the general ledger, adjusted trial balance. After the adjusted trial balance, you're ready to do monthly financial statements. Then, at the end, you'll do that up for 11 months. 12th month, we'll do daily journal entries, posting into the general ledger, unadjusted trial balance. Then we will do, at the end of the month, adjusting journal entries. Then we will post those into the general ledger. Then we will get an adjusted trial balance. Then we will do financial statements. Then that extra step in the 12th month is closing journal entries, posting into the general ledger, post-closing trial balance, and we're ready for the new year. Okay? So I hope that gives you a little bit of insight on how all of this is working and fitting together. Let me know if you got any questions.